Welcome to Thoughts on the Market. I'm Michael Zezas, Global Head of Fixed Income and Thematic Research for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about Congress coming back in the session and its impact on markets. It's Wednesday, September 6th at 10 a.m. in New York. Congress returns from summer break this week with a full agenda. Expect to see tons of headlines on various policies that markets care about. Tech regulation, artificial intelligence regulation, defense spending, disaster relief aid, and the risk of a government shutdown are just some of the issues that should be tackled. It can be a bit overwhelming, so here's our cheat sheet for September in DC to help cut through the noise and understand why this could be a good setup for U.S. bonds. On tech regulation and AI, don't expect any meaningful movement here. New versions of legislative proposals on data privacy and liability for spreading misinformation may come, but there's still no comprehensive bipartisan agreement that could turn proposals into law. So we continue to expect that this only becomes possible after the 2024 election delivers a new government makeup. On defense spending, we expect that aid to Ukraine will continue and that Congress will approve overall defense spending levels in excess of the cap set by the agreement put in place alongside the hike of the debt ceiling. There's bipartisan agreement here, with the exception of House Republicans. Resolving issues with those holdouts will likely take brinkmanship over a government shutdown, and perhaps even an actual government shutdown. But ultimately, we see a deal that should be positive for a defense sector which has benefited recently by elevated spending by Western governments. The biggest story to track, though, is that risk of a government shutdown. As we previously discussed on this podcast, a shutdown is a real risk because House Republicans are not in sync with the rest of the House of Representatives and Senate on spending levels for fiscal 2024. Further, there's the sense that both sides may rightly or wrongly perceive political value in a shutdown. So there's both motive and opportunity here. And while a shutdown on its own is not sufficient to ruin our economists' expectation of a soft landing for the U.S. economy, it does add some fresh downside risk to growth in the fourth quarter, which our economists already expect would be challenged. Major entertainment events in the U.S. boosted consumption above expectations this summer, and those effects should start to wane at the same time that the student loan moratorium rolls off, meaning many households will again have to direct some level of their income away from consumption toward servicing loans come October 1st. Put it all together, and it's a strong rationale for our view that high-grade bonds have value here. U.S. government bond yields should be near their peak, with the market moving beyond the notion that the Fed may have to hike substantially more this economic cycle. Thanks for listening. If you enjoy the show, please share thoughts on the market with a friend or colleague, or leave us a review on Apple Podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.